This week, we're going to be talking about what does significant dilution mean. And what I was going to say is in the live stream 13, I actually talk about this in significant detail. And what I talk about is basically what the price, the dividend is versus the price of the share currently. So since Cineworld went into Chapter 11 filing way back now, I don't actually remember the exact date that they filed Chapter 11 bankruptcy. If you do, leave it in the comment section. We don't actually know that there is going to be any dilution. It's just that part of the deleveraging is likely going to be significant dilution. And I don't actually have examples of what this means for other companies because it could be so unique to the type of company. Cineworld are unique because they have a lot of capital leases on their balance sheet. And actually, by removing sites, by removing cinemas, they actually wipe off a lot of their debt that way. And then other bits of their debt that are making up their enormous debt bubble are things like obligations to other studios. So things like they owe money to James Bond for putting their film into the cinema, and then they give that money back to James Bond. So I think cinema's debt looks higher than most other businesses generally anyway. But they do have significant debt owed to banks, which is what needs to be paid off very soon, which we are hoping Avatar will deal with. And what I'm going to be talking about later in this episode is what my thoughts are on Avatar as well, by the way. And so, yeah, dilution. We know that in 2019, the dividend, we only had a short amount of time to see the financials of Cineworld after purchasing Regal. We had a short period of time, and what it looks like is that Cineworld, acting normally with Regal, has around 3 billion revenue. And that is with Endgame, but this year we have Avatar, and Avatar is pulling similar numbers to Endgame. So we could actually compare that in a bit, actually. That would be an interesting comparison. 2019 is what we're kind of basing our figures on, because we are, as shareholders, we're sort of thinking that we're going to go back to 2019 after the pandemic. And so in 2019, the dividend was 500 million. And right now, the share price is 50 million. And 50 million is around 3 to 5p per share. And so right now, if there is no dilution, then what you'd be doing is you'd pay £1,000 for the stock and you would get £10,000 in a dividend in a normal year. And you can assume that if there was no dilution, the share price would go up enormously. Now, if Cineworld printed double the amount of shares that they currently have, so let's say they have 1 million shares and they print 1 million shares and give that to the bank in exchange for debt, it's likely that they give something more. Significant dilution would probably be something more like 5 million shares, or it depends. It's all about to do with how good Cineworld are at leveraging their position and how good the banks are at leveraging theirs. And there is a chance that in this dilution event, shareholders' equity can get wiped out entirely. Now, the thing with that is, in some companies, the board of directors are not stakeholders most of the time. And in a lot of events like Hertz, one of the largest stakeholders sold out right at the beginning of Chapter 11 bankruptcy filings. And we actually did see a little bit of that with Cineworld, but we've still got Mookie, the CEO, who has written a letter that he still holds, the Mookie Gerdinger family still holds its 20% stake in Cineworld. So in the event that shareholders get nothing, Mookie, the board of director chairman, who is the CEO of the company, is the largest stakeholder, currently holding his position. So it seems, at the very least, if we get wiped out, so does he. Whether they would then keep him on as CEO in the new company and start gifting him shares as time goes on, that is potentially an option. But one of the things is, with public companies and with investing, one of the key things is good faith. And Cineworld would lose a lot of good faith, I think, if they did this. Significant dilution would need to be at around 1,000 times. So let's say you got 1 million shares. If they printed 10 million shares, that'd be around 10,000 percent dilution. Oh God, I'm pulling these numbers out of thin air. That would be significant dilution. In that event, if they were to do that, a 500 million dividend would still come out to a sort of a 5% yield. So yeah, significant dilution would need to be crazy from where we currently are to make this not a worthwhile investment. The risk, the way that this stock is being priced, however, is as if it's going to go to zero. It's basically priced as if it's gone bankrupt. Not that it's going to have significant dilution, that it's gone bankrupt. And that's the event that I think is unlikely, that equity holders will get absolutely nothing. And that is why I think that it is a interesting trade at this point in time, because the market is basically saying, forget this stock.